Hello, welcome to Financial Compliance and Module 1, Monetary Policy. Module 1 and 2 are really interchangeable in that you can do them in any order because they're really just designed to lay some background for what we'll be talking about throughout the rest of the semester. So the reading started with really talking about, what is a bank? What's a financial company? And the key thing about a bank is the transaction account. The fact that a bank can accept deposits. This is somewhat similar to a couple of other highly regulated types of companies, insurance companies and investment banks. Those are kind of the two other types of financial intermediaries. And anytime a company can take your money, the government wants to make sure they're reputable. The other key aspect of banks is their role in the U.S. monetary policy, and that's really going to be our focus today. And this is to give you a sense of, in part, why banks are so highly regulated and how they are such an essential part of the government's implementation of monetary policy. But taking a look first at the transaction account, which is your checking account traditionally, although there are many other ways to pay for things these days, or even invest your money, direct investments, crypto, using just cash, you could barter your services. There is both a security and a flexibility with bank transaction accounts, the ability to pay your bills, the ability to pay your employees, that make it really essential to how the economy operates. And as some of the questions in your reading talked about, although there are, of course, other ways to get a higher rate of return, bank accounts remain popular because of their convenience as well as their stability. There's a chart in your reading on page 257 that lists the different types of institutions as well as the numbers of those types of institutions and the assets held by those institutions. The numbers, of course, and the assets are always changing, but they're going to keep the same pattern. And that is that banks are going to be the largest holder of assets, although the smallest in number. Thrifts kind of in the middle, credit unions, smallest institutions, but great in number. What's important for us is that the start of financial compliance is determining what institution you're dealing with, because different laws and regulations govern all of these. There may be common regulations that apply to, say, all FDIC insured institutions, but credit unions are under completely separate laws, and state banking laws are somewhat different than federal banking laws, and thrift laws are somewhat different than commercial bank laws. So it's very important, if you're in this financial compliance space, to identify the actual institution that you're working with so you understand who your regulator is and what laws you need to be focusing on. But there is some commonality, obviously, as we will talk about throughout the semester. And as we saw in one of our cases, there's also a bit of push and pull between state and federal regulation. And this is called the dual banking system. But our focus today is actually monetary policy, just by way of background. And in the US, it's the Federal Reserve that is the government agency that is responsible for implementing and actually setting our monetary policy. There are 7 members of the Board of Governors of the Federal Reserve. They are appointed for 14-year terms by the president. A 14-year term is a very long term. And it is an indication of the desire to keep the Board of Governors somewhat out of the political fray. Of course, as we all are well aware of, that's impossible, but a 14-year term does make an individual less susceptible to political pressure. The president appoints the chairman for a 4-year term. And then under the Federal Reserve, there are 12 Federal Reserve banks. Ohio is in the 4th district. The bank is actually in Cleveland. And the Federal Reserve banks are really the banks for the banks. So it's where the banks borrow money from, and they can also deposit their money there as well. The Federal Reserve serves as a supervising and examining authority. They examine and supervise all national banks and state banks that choose to be members, as well as the holding companies. BHC and FHC are abbreviations for bank holding companies and financial holding companies. We will talk about all of these topics and entities in far more depth throughout the semester. This is just sort of to give you a sense of the regulation and the structure. But the Federal Reserve is the agency in the United States that regulates, of course, the largest institutions as well as their holding companies. And the law even permits them in certain instances to regulate non-banks that are significant to the US economy. They also are the lender of last resort to ensure liquidity for banks. And they also offer services such as check clearing and ACH payment networks and federal wire service. So they are a service provider. They engage in a great deal of research and evaluation of the US economy. They write papers and they advise banks and are a source of information for banks. By statute, as a federal agency, it's created by federal law. The Federal Reserve traditionally has 3 tools to implement the monetary policy, and these are all in some part implemented through banks and through the financial system. So the first are the reserve requirements, and this is a tool that is really not used today, as we read about. The second is the discount rate. The third is the open market operations. And as the Federal Reserve uses these 3 tools, by statute, they have 3 goals. One is maximum employment, which has recently been good and strong. 2 is stable prices. We've seen inflation. That's obviously something they're reacting to. And moderating long-term interest rates. And in a sense, they don't want the rates too low or honestly too high. And what is the appropriate level? So as I mentioned, and as we have read, the Federal Reserve has adopted the ample reserve approach. And they started that on March 15th of 2020, which is, if you think about it, that is sort of the date that we all became aware that the pandemic was going to hit the United States, or was in the United States, depending on where you lived. And they reduced the reserve requirements to 0. Part of this, as explained, is because they were now paying interest on deposits, but they've been doing that since 2006. And part of it was to ease the money supply, that they perceived that there could be some kind of panic in the economy. And by reducing the reserve requirements, which is how much the banks were previously required to keep on reserve with the Federal Reserve, to 0, it puts more money in the economy. And was going to strengthen the liquidity at a time that there was a lot of, honestly, fear and uncertainty. We did read a case about these reserve requirements, and it kind of gives you a sense of how important these have been for banks historically. As the case talks about, initially, it was only members of the Federal Reserve that had to have a reserve requirements, and the state banks typically didn't, and this gave them an advantage. As I mentioned, we have a dual banking system, and there's always competition between the state and the federal banks. And so the Federal Reserve decided this was unfair, that state banks weren't always required to keep reserves, and they imposed the reserve requirement onto the state chartered banks, although they gave it an 8-year phase-in. And this is very common in banking law. It's called a grandfather clause or a grandfather provision, where they said that it would not apply until a certain date in the future, and they would have a certain date that they looked at. And here we had a bank that was switching from a national to a state charter, in fact, to avoid these reserve requirements. And the question was whether or not they going to get the benefit of this grandfather clause. And really the holding is not that important for us. Important for us are these concepts of the dual banking system, like competitive nature of the state and federal regulation, as well as this grandfather clause. And so this is just a good case to introduce some kind of key concepts that we will see throughout the semester as we look at financial regulation. The second tool, which you may be aware of because it does make the general press, is the federal discount rate and the federal funds rate. This is the rate set by the Federal Reserve. The federal discount rate is the rate at which the Federal Reserve will lend to banks. And the federal funds rate is the target rate at which the Federal Reserve has said the banks should lend to one another. And I've given a few examples here on this slide where you can see the rates were fairly low in 2018 and 2019. This was coming out of the financial crisis of 2008, trying to kind of build back up the rates. Then we had the pandemic where the rates were dropped to put money into the economy and to kind of help stimulate the economy. And then we've seen a period of inflation where the rates have been really rising at somewhat of a historically rapid pace to tamp down inflation. And so you can see just from this small example how the Federal Reserve has used these rates to either try to tighten or loosen the money supply, which has a huge ripple effect through the economy, as well as changing the rate we're getting on our savings accounts, what someone can get a mortgage for, what someone can get a business loan for. So it's a very kind of effective tool. As I think you might have read in your reading, it used to be that most banks were borrowing from the Fed, but since 2003, the Fed has encouraged the banks to lend amongst themselves. And so basically what that is, and this is oftentimes just overnight lending, if a bank finds at the end of the day that they have more money than they feel they need, they will lend to a bank that is a little bit short on funds. And so, this is a way that they kind of keep the banks, liquid and keeping the banks efficient, because having too much money on deposit at the Federal Reserve is not efficient for the bank. The more money that's out in the economy, the better for the economy. But having too little is also not good and puts a bank at risk of bad things happening. So as we'll talk about the Federal Open Markets Committee, that's sort of how they look at the economy to figure out what should be the rate. What is the appropriate rate that will achieve the goal of full employment, stable prices, and interest rates that are suitable for the economic condition that the country's in. I did just put up this chart here in the PowerPoint just to show you how the federal funds rate has really gone up and down over the years. You can see down there in 2008, very, very low. And in the 70s and the 80s, we had really rampant inflation as well as really high interest rates, which is really great for depositors. The open market operations is really the most sort of complex and sophisticated arm of the Federal Reserve. And this is the kind of the tool that, in addition to setting the federal funds rate and the rate that kind of sets all the other rates, the Federal Reserve also can purchase government securities from banks or sell government securities. When they purchase government securities, they pay the bank, credit the bank, and it puts more money in the economy and tends to lower interest rates. When they sell these government securities to banks, they basically take money from the banks, which decreases the money out there in the economy. And so this is a very fine tool that they can use on really a daily basis to adjust the monetary supply, which again also has a ripple effect throughout the economy. So kind of the point of this discussion and this module is to understand the important role of banks in carrying out U.S. monetary policy, and one of the reasons why the banks are so highly regulated, as we will study throughout the semester. There is just a great deal of regulation and examination of banks. And part of it is kind of their role in the monetary policy. The Federal Open Markets Committee is a private-public group of people. So we have the Board of Governors, as well as the president of the Federal Reserve Bank of New York, and of the other 11 banks, 4 of them sort of rotate. So these banks are really considered private, although they are, kind of quasi-public because of their nature and the role in implementing U.S. monetary policy. But it is somewhat of a public-private kind of effort to keep, the economy, and as well as to study the economy. So these actions are done based on all kinds of economic data, as you can imagine. The other thing that we also see is the bank presidents, as well as the members of the Board of Governors of the Federal Reserve, as well as just the employees. They do speaking and they do writing, and this also can send a message. And it's also a way that these agencies can see how the business community and the economy reacts to ideas. And so just kind of to end here, as an example and we kind of saw this in the chart, during the financial crisis in 2008, they did reduce the federal funds rate to 0, which was really unheard of at the time. And they were purchasing securities in an attempt to reduce rates, which was putting money into the economy. And they were speaking a lot about the fact that they weren't going to raise rates anytime soon, and they were going to keep kind of pumping money into the economy. And so, I encourage you to listen to the financial news and, share it on the discussion board, because they do actually float ideas through speeches and other public statements. And so I hope throughout the semester, we can talk obviously about the nuts and bolts of financial compliance, but also keep an eye on sort of the bigger picture of how banks and financial institutions have a big role in the U.S. economy. So please feel free to email me with questions, and I'll see you for the next module.